We've got some fresh new young talent doing some things that I know you haven't heard before.
1, 2, 3, listen.
You got to have the why, and we know our why. So
You don't need to reinvent the wheel.
Yeah.
Millions and millions of people have done this already. You can get help, you can get a roadmap, you can save a lot of time, money, and frustration. Welcome to the Value Add Podcast with K&K.
Hey everyone, welcome back to another episode of the Value Add Podcast with K&K. I can't even talk today. Today, it's my turn to torture Mitch and Krystle. And today, we're going to learn about apartment financing, multifamily financing 101. We're so excited.
Woohoo!
So, you know what's funny is like why we're doing these podcasts, if you people really want to know, is because everybody thinks because you're in your industry and you think you know everything, maybe you do, but 98% of people outside, they really don't know anything. And so us breaking down stuff simply has really been helpful because when we want to learn about stuff, what do? We
Google it.
No, but we listen to YouTube, but we listen to the simple, dumbed down things, whether it's marketing or anything, anything. The simpler, the easier. That's how you learn. Mitch, no?
Yeah.
Mitch is just looking at me like, what the hell are you talking about?
He's waiting for a question, man.
So I got my little
You're
cheat
taking
sheet
control.
here.
You're interviewing, so.
So, how long you guys been doing apartment financing?
About 16 years now, since I was 19, so
She's done about $1 billion worth, so you've done a few loans.
just a couple.
Okay, so basically, I'm going to play Mr. Consumer today, and you guys are going to play the lenders. And I'm
Kind of
going
what we play every day.
That's- yeah.
That's good.
Pretty good at that role.
So, I mean, this could go for refinance or purchase, right? What we're talking
Yeah,
about?
I mean, it's all pretty similar.
Okay, so
We'll
can,
break down if there's some sort of a difference.
so you can break it down for us.
For sure.
Break it down for the audience.
That's right.
Break it down, baby. Okay, so when should an owner, buyer contract a broker? It should be contact a broker. So
Contact.
who wrote this script? Rose, get in here.
When should you contact a broker? I think we were just talking about like if you're looking at, buying a building or something like that, when would it be smart to contact a broker, as in like a mortgage broker or a lender? You really should contact your lender or a broker at the beginning.
Contact a broker.
Whenever you're like looking for an apartment building, you should call them because it's different than residential. So if this is your first apartment purchase, you can't just go into it with this idea that if I look at a building and there's a building for sale, I want to buy at $1 million, I'm just going to go get a $750,000 loan, or I'm going to put 25% down, or whatever the case may be. You can't do that. We qualify based on cash flow. So you want to contact your lender up front. So that way, if you're interested in purchasing a property, you know that you have enough money to put down and that you can get a loan.
So just to make this clear, if I'm a doctor and I make $1 million a year and I would buy a 1 to 4 unit property and I can qualify based on my income, nobody cares if you make $1 million a year or you make $100 million a year. You guys lend off of what the property cash flows.
We basically qualify the property for the loan. It has to be able to service the debt, and we have certain lending parameters around that, how we qualify. So you want to make sure that you can get the loan amount, and really the fact that you make $1 million a year or $20 million a year really makes no difference, because we're looking at the property to support the debt. We look at your global cash flow kind of secondary to the property.
Okay. So when somebody so basically, if nobody's ever got a commercial loan, Mitchell, and let's say they've gotten a residential loan and they're going to contact you. I mean, for residential, we've got bank statements, tax returns, all this stuff. Are you going to ask for all that, or what exactly are you going to kind of like ask for? Just like, is it going to be this whole long list of shit, or is it going to just be basic? Or
Well, eventually we'll have a long list of stuff, but right off the bat, we're going to be looking at the property information. So we're going to want to see the rent roll. And
what if they don't have a property? What should they do?
if they don't have a property, then let us know what property they're looking at, and we can usually pull some information or some market information.
So
for
if they don't
property
have one
types
they're
in the
looking
area.
at, you should say, look, let's you could say, how much money do you have, right? You could say you have $500,000. So you're not going to be looking at a $5 million building. So you could say, hey, look, for example, you have 500,000. This is a property. You could say, you could give somebody a property, right?
Yeah,
Like if
we
they have a broker,
can give
you
them a
can talk to the
property.
broker.
We
If they
could
don't-
say, hey, this is, how much they have to put down. This is,
okay.
what, and depending on that, it could be a 5-unit property, could be a 10-unit property, could be 20 units. It kind of depends on where, where they're looking.
So it's minimum 20 to 25% down.
Probably the more like.
But the farther west you go, like the less
So
likely it
guys,
is that you're going to get.
West means closer to the beach. So if you're going to buy a property, we're in San Diego in Pacific Beach, and you're going to buy a 5-unit, or you're going to buy a 5-unit in, Vista, the beach you could be putting down 50 to 70%.
In Vista, you can still
Vista,
put down
yeah,
30,
maybe
35%.
put 30,
So, but that's what we're
35%,
saying. There
so.
is a difference.
Yeah.
So, so once again, qualifying, because this is a big, big thing. Just because you make $1 gazillion a year does not mean you can just walk in and get a commercial loan based because you have all this money. It helps because it makes you look good, but they're going to go off the property.
And also, like what I was saying is farther towards the coast, because I'm sure this is the case on the East Coast as well. I mean, the closer you get to the coast, the more money you have to put down. So if you're in the Midwest somewhere, maybe you can get 80% loan to value. Even, a lot of lenders will go 75 to 80% LTV, but we're just not really seeing it that much here in Southern California. Once in a while, you see some like fluke situation where somebody gets 75%, and that's usually in some of these more what we call transitional neighborhoods, where it's like maybe a rougher neighborhood, and therefore you can get maybe a higher LTV, but generally we're seeing like 30, 35, maybe 30 to 40% down.
A good kind of rule of thumb is the lower the cap rate, the more the down payment.
Exactly.
So if you're looking at something that's at like a 6 cap or higher, you could probably get close to putting, the minimum down 25%.
That's a good little rule of thumb.
Yeah.
Okay. But if you're like a 4 cap.
And a 4 cap, you're probably putting 35, 40% down.
Okay.
And it's not saying you can't,
And if you're like a,
but
if you're
going into it, that's kind of a good
and
rule
if you're
of thumb
going
to
like
look
3 to 3.5, like beach or something, you're definitely
you're
getting down
putting
there.
40, 50% down.
Okay, cool. Okay, so I think what would be cool today is talking about for somebody that, let's say we have clients that come to us all the time that have been buying residential, or they came into money, or somebody said you should buy multifamily, right? So you guys get a call. They could have talked to a broker or not talked to a broker. They're like, hey, I heard the first person got to talk to you, just like when you're going to buy a house, is a lender. So they call you up. So let's kind of walk through, like we put down here. I want to walk through the process and stuff like that. So like the first thing is whatever Mitch, Krystle answer. What is the initial conversation going to be like? I'm Joe Blow. I've got $1 million. I've never owned apartments, right? I make good money. I have good credit. I have one house. I saved up money, and now I'm like, I want to start buying apartment buildings. And I call you. How's that conversation going to go?
Well, usually that is educating them on the differences between what they're used to with residential and what an apartment loan looks like. There's a lot of differences, and not to plug us here, but we have a YouTube channel that we kind of break down some of these things. So for example, like what's the difference between multifamily and residential financing? So you kind of can figure it out. But so we would kind of go through that conversation. For example, that, you don't get a 30-year fixed on a multifamily loan. So just be prepared that you're looking at 5, 7, and 10-year fixed. You're looking at getting a prepay more than likely. You're looking at having to get your cash flow to qualify for the loan amount. It's not just a cut and dry 75% LTV or 80% LTV. So once you kind of get them past that idea, you're usually also too walking them through. I mean, I definitely believe in educating people. So you want them to kind of start to think about the process. How do we qualify? So then we'll kind of talk to them about how you break down qualifying, that, we use a minimum or usually it's a 5% vacancy factor, where even if you're going to self-manage, we're going to have to use whatever the management fee is that's typical for that size of property for qualifying. We're going to need to add replacement reserves into the expenses for, capital improvement items or like things that might come up. So all of those things are going to count into your debt coverage. Okay. And then we educate them on what is debt coverage. Most people don't even know what that is. So that's kind of like the initial conversation.
And Mitch, would there be anything, I kind of wrote down here, from that conversation through the process? Obviously you have a conversation, but is there something where they're like, okay, great. So I've got this property I like, right? I got $1 million. I like this property. It's $2.5 million. If they say, hey, Mitch, can you tell me if I can qualify? That initial process, because that's what I'm assuming what it is. What is detail? Like when they say, hey, do this, what is going on? What are you doing to say if you qualify or not?
Yeah, so if they've got a property in mind, that's where that's where I kind of come in. I'm the numbers guy. So take a look at the property's financials. So each property is going to have separate financials. The first is going to be the rent roll, or that's where we look at the income, the gross income. Is there parking? Is there laundry? Is there other stuff that we can kind of count for qualifying? Once we figure that out, we look at historical expenses. Then we also look at what the new tax rate will be and factor that into expenses. So just because the property.
So, quick question for you: income expenses. Where are you getting that information from?
That's typically from the marketing package.
Okay.
If they're looking to purchase a property, it's probably listed. There's probably a marketing package. Marketing package is put together based off of actuals at the property.
Do you trust those marketing packages? Do you think those are accurate? So if I'm a buyer, right? I've never done this. Or is that really, and I send this over, should I really go off that, or are you guys going to verify, or how does that work?
We will verify it. Most of the time, those are fairly accurate because it's a representation of the property.
But fairly accurate.
We also look at that compared to what market expenses are. So the property may have almost no repairs for the past 3 years because tenants don't move. We still factor in a certain dollar amount per unit for repairs
regardless,
that are
you're going to hit them.
That are going to be hit for qualifying.
That property could have been self-managed. It doesn't matter.
We add a management fee in there.
Okay, cool.
So one of the things we do is banks look at the property as if worst case scenario and I have to take this property back, what kind of expenses am I going to operate it at? Banks aren't landlords. They're going to have somebody else manage it until it gets sold off their books. So we have a good idea of what those market expenses are. We add that in there. You take your income minus your expenses, you get your NOI or your net operating income. That and then whatever debt coverage ratio the property needs to qualify for, and the qualifying rate determines the loan amount.
And what is debt coverage ratio? What does that stand for? What does that mean? In
debt coverage
terms?
ratio, typically it's 1.15, 1.2% for purchases. And that means that, if I have $1,200, it qualifies for $1,000 of payment. So
Okay.
1.2 to 1.
Okay. So it's that simple.
So
Okay.
pretty
So
simple.
you're going to take, I've got a 10 unit, you're going to take all the rents,
all the
put
rents
them together, and then that's how you're going to come up with that.
Yes.
Okay, cool.
So that's where we come up with the NOI. NOI, divided by the debt coverage ratio, and then we back in the qualifying rate. So your start rate may be 4%, or your loan may be 4%, but we qualify it at 4.5 or 4.75. It's another little buffer in there for anything that may happen. And with that determines the loan that you're able to get. So
Okay.
So your NOI divided by your debt coverage ratio essentially equates to the monthly mortgage payment that the property can support. So from there, then you back in, okay, it's a 30-year loan and it's a 4.7 qual rate or 4.5. Then what's that loan amount?
And
So
do
that's-
you guys have videos on your right now on the YouTube channel that talks about cap rate and stuff like this?
We do.
Okay,
Yes.
so they can go there.
Yes.
It's on the YouTube.
It's on the tube.
On the tube.
Okay, so at this point, you don't necessarily need any documentation from me to size the property, or would you?
Other than the marketing package, and if you have the property's financials, so rent rolls and
So
past
you
I
would-
like to
P&Ls.
verify for sure. I mean, for me personally, I like to verify, and I'll always ask for it. We can kind of upfront do this, but we always preface it with we need actuals, because even though
So you don't need my tax returns. You don't need anything like that.
we
at
don't need
this
tax
point.
returns.
Not-
or anything
not
like
to
that.
size the
We
loan.
usually
Okay.
do request a personal financial statement and a real estate schedule, because we do want to get the strength of the borrower.
So, quick question for those of people that don't know, what the hell is a personal financial statement? Because we know what it is, but a lot of people don't know what it
It can be
is.
the equivalent of a loan application, but basically it's a statement that shows your assets and your liabilities. And then if you have real estate, you would have a real estate schedule, which just breaks down the real estate that you own, like the market value, the debt you have on it, the income, the expenses, and you're either, it's either a liability for you or you're actually making income off of it.
Okay.
So that's what we look at initially, just to kind of make sure. I mean, if you're just buying your first apartment building, it's not that you can't buy it, but we want to know these things up front, because some lenders might be a little bit more conservative if you don't have experience. They may require you to get professional management if you don't have experience. So these are the kinds of things that we want to be able to guide you on up front so that we can manage your expectations.
So if I'm a buyer and I'm new to this, what type of questions should I be asking to a lender?
So if you're a buyer, what kind of questions are you asking a lender? I would be getting just the kind of basic details, like what's your max LTV, what's your debt coverage ratio, your rates, prepayment penalty. I think that's really the biggest thing.
Real quick, prepayment penalty, can you go over that? Because if somebody doesn't know what it is, what exactly is that? How does that work?
A prepayment penalty is a penalty you would pay in the event that you pay off the loan, which would include refinancing or selling the property. So, and usually what's typical, especially if we're talking like somebody who's getting into the business 101, typical is a step down prepay. So for example, if you get a 5-year fixed, you might have a 5-year prepay. So year one could be 5%. That would be 5% of the balance at the time of payoff. Wow. Year two would be 4%.
So if you have a $1 million loan, you could pay $50,000 fee.
You could.
Okay. So that's why what you're saying is one of the important questions to ask a lender is, because different, and my understanding is different lenders have different prepays, right?
Yes. They do.
So not one size fits all. So that's why if you go talk to a bank and you're like, oh, I'm going to go with this bank, and you're new, you might not understand that, hey, you could have got that 5-year term instead of a 5, 4, 3, 2, 1 prepay. You could have got a
3-2-1 or
a 1 or whatever, right?
A
0.
1-1-1.
So this is why I'm just addressing. This is why when you talk to somebody, if you talk to one lender, one bank, that might be their product. But that's not even close what could be out there. So that's why having a broker, even if you talk to a broker, this is why they're going to have 20 options.
Yeah, and we're going to lay out all the terms. So sometimes, you may be inclined to go with the best rate. But it's not always about rate. There are other terms. For example, some lenders will allow you to pay off up to 20% of the loan balance on an annual basis without incurring a prepay. So if your goal is to pay off your property, you could, go with a program that allows you to pay 20% a year without incurring a prepay. So, or you could go with a lender who maybe has a little bit of a shorter prepay because, look, you're buying an apartment building. It's an investment. So that could be a vehicle for you to purchase other real estate or for you to grow your portfolio, or maybe you're going to sell it and trade up to another property. So these are the things you need to be thinking about. This is not your home, even though people don't, just buy a home and keep a loan for 30 years. It's like rare that anybody ever does that.
5 to 7 years.
Right. So most people are refining every 5 to 7 years. I would say that that's also true for apartments, except for I would say that people are refining every 3 to 5 years,
especially lately,
usually because you want to pull cash out so you can go buy more property, or so you can fix up the property, or you want to sell so you can go buy a bigger property. There's like a lot of reasons why you would utilize your investment to cash.
You talked about know what their max loan to values are, which is loan to value.
Know what the max LTV is. Get the rate. Obviously, you're going to have
the rates,
the DCR, the rates. The prepays. And then there's one thing I just thought about, and Mitch, I don't think people realize this. If you're buying $1 million property and you put 30% down, that's a $700,000 loan. There's some lenders that are under $1 million and even under 500,000, where they're like, you might think you're calling them like, oh, this is a good lender. They're like, they're not the place to go.
Yeah, there's certain lenders that anything below their sweet spot or their threshold, they price it up. They don't like those.
Why do they price it up?
It's every loan costs the bank about the same amount to do, and the lower the loan amount, the lower the return. Right? So they want bigger deals because they're paying the underwriter, they're paying the processor, they're paying the servicer. There's a certain fee associated.
So if they're doing a $300,000 loan.
It's the same work as $3 million. So they're going to get better return on $3 million. So they price it up to make that difference, or they just won't even look at those.
A lot of times I would say even a $300,000 loan could be more work than a $3 million loan, because you're probably dealing with a person, unfortunately, who can only afford a $300,000 loan, so their income is tighter, they're not looking as strong financially.
The property could be in a tougher area.
Yeah.
Okay, cool. So. The other thing is talking about that is, just because you go to your bank, they could be, I don't know if the word's prejudiced to certain areas. Some banks are like, we don't. That's not our footprint. That's
So
Yeah,
these are
there-
considered
there's-
business loans, so they can certainly say like, we don't like this area, we don't like.
this is not RESPA.
Yeah, we call
There's
it
no redlining,
we call it cherry
like-
picking. Some
yeah.
some lenders they will cherry
they're
pick
allowed to-
certain
and they're allowed
areas.
to do that. They have the right to do
They
that.
are, yeah.
Okay.
They can determine where they have a footprint or what market they are in. So there's certain areas that they don't have a footprint, and they won't lend in those areas.
And I think this kind of goes into the next question, which is people might not know what their fears or frustrations are because they haven't gone through the process. But I think just us talking about a few of those is I'm going to bring some up. If I'm a buyer and I've never bought a multifamily property, let alone from who's going to manage it to how do you collect the rent to bank account, all this other stuff, right? That you have to learn. And maybe you have a management company that'll take care of that off of you, and that's another podcast. But getting a loan, when we deal with people that don't know anything, I think just knowing that is some of your fears should be, and we can address these, is does this lender lend in this area? Do they do these type of loan amounts? Is this going to qualify? Does the banker behind there know what the hell he's doing? Is he really going to guide me to the right direction? So what do you guys think? If from a buyer side, right? If I'm buying a property and you guys have been doing this forever, what are 2, 3, 5, whatever it is, what are the fears or frustrating points that you guys see a lot of people have that we can talk about to maybe mitigate or help people understand that, this is what it is? And I know, Mitch, sometimes people call you up, they're like, that's ridiculous. What's a $500 loan? Why can't they just give me the same rate? And you're just like, you try to explain it to them, and they don't know. You're like, sorry, it's just the reality of it.
Well,
Yes.
also too, I feel like we should run through one thing before we talk about the frustrations
Sure.
that we didn't get to, which is like the process of getting a loan is so different. Like, and what I mean,
Well,
you guys,
that's coming up.
Yeah. So
Yeah. So you're jumping ahead.
okay, fine.
Yeah,
Go
so,
through
well,
the
I think-
frustrations.
First the fears that you mentioned, like will they lend in this area, and like
For sure.
how does it qualify, all that stuff, like that's addressed up front in getting your letter of interest. So those fears are taken care of pretty quickly. One of the fears is, and I guess most frustrating parts is, with residential lending, you're used to, hey, we ordered the appraisal, it's back in 3 days, and I know the value done. With commercial, you're looking at like 3 weeks, and that's after you get the LOI.
Question
after
on that,
you,
can you pay for
submit
like a
deposit.
rush?
You can.
It's not that much faster though.
And
Maybe 2
yeah,
weeks
maybe you get it in
instead
2 weeks or 2.5 weeks. So there's certain times where it makes sense.
This is a different
but
game. You've got to be more patient. So frustrations are used to closing in 30 days.
Yeah, it's a 45 to 60-day process in most cases, and there are some cases where we're able to expedite that.
Then you just close the
we are
deal
able
in
to
21
rush.
days or something, you guys?
Yeah, we closed the deal in 21 days. The
And
buyer
we closed
came.
in 30.
Yeah, they
too.
But
came
that's
in
because
very
you
prepared
guys,
with all their paperwork.
But that is because people
we
listen
set
to
the
you, organize-
expectations with
exactly.
what we needed with the lender. So there are instances, but by and large, it's a 45 to 60-day process, and you'll see that when you go into contract. If you're writing an offer on a property, your broker's probably going to put a 60-day time frame on there. If the seller counters back to 30 days, we can make it work, but everything's going to need to fall right. So that's one of the things. It's a frustration that it does take a little bit longer. You'll be 3 weeks into the process and not know if the property value's out. So that's
Well, also,
that's
too-
a that's
Well,
a
not to
fear.
mention
That's
that
a
you're 3 weeks-
frustration.
You're 3
and-
weeks into the process, and you think you can get the loan amount that we got on the LOI, but if that appraisal comes back with a little bit higher expenses, it's going to get adjusted. So it's like, this is different. Like I said, when you go to get a residential loan, it's not like your purchase price is $1 million and you're going to put 25% down. So you're getting a $750,000 loan amount. The only thing that could
Your
go
income
wrong,
qualifies on it. You're good
the
to
only
go.
thing that could go wrong is that the value doesn't come in. For
yeah.
us, what could go wrong? The value doesn't come in. The expenses are higher. The appraiser thinks your market rents are, a little lower, or something. Like there's like basically we're looking at income and expenses.
Let me ask you one thing about the appraisal. So the other thing in residential, right, that could be a problem is they go out, they appraise the property, and you come back and there's mold, there's a hole in the wall, there's a leak in the roof, which obviously it's like the appraiser says, well, you can buy the house, but this crap's got to
this
get
stuff
fixed.
needs to get done.
So for you guys, if the appraiser goes out, is he looking at all this stuff? Could he note that there's this problem, and could that be a problem?
Oh, yeah.
Like what can that cause? Because that, to me, that's a huge fear. That
So
could be a problem.
there's a couple things that can happen if he notes significant deferred maintenance. So there's really three things that deferred maintenance will either be health and safety items or just something that needs to be addressed that's going to possibly affect value.
Okay.
So if it's a health and safety item, it's going to have to be repaired prior to closing.
Okay.
You can't have a tenant occupied property with health and safety issues. It's red flags everywhere. If it's something that maybe affects value or it's going to cause problems later on down the road, the lender may say, hey, we'll go ahead and give you the loan, but we're going to hold back X amount of dollars until this is fixed. So say, hey, the roof's pretty close to the end of its life. It's not leaking yet, but it looks like it's going to. So it's going to be $20,000 to fix it. They'll hold back like 110% of that amount until it's fixed, and then they'll release that money back out. So you get your money back, but you may have to come into
That could be frustrating.
come in with more money
That's
up
frustrating
front
because you didn't plan
until
it.
you get it
so
done.
Example, let's just use an example. I'm buying a property for $1 million. You guys say this qualifies for a $700,000 loan. The appraiser goes out there and finds $50,000 worth of damage or work that needs to be done. The lender comes back and says, hey, we're going to give you the $700,000 loan, but unfortunately, as of right now, we're only going to give you $650 and we're going to hold $50
until
so that
these
means
repairs are
you need to come in with additional
$50,000.
Yeah.
Then
whatever.
you have to do the repairs, pay for those repairs,
and then
show
get
them the
reimbursed.
invoices that they're done with pictures of completion. Then they'll give you the money
And
back.
then you guys been through this.
And you're
so-
paying interest on the $700,000, not the $650,000.
Okay, cool. So you've been through that. Is that something that will get done? Is this like, oh, I'm never gonna get my money back, or is this like you do the work, you get it back?
It's in
Yeah,
an
it's-
escrow account.
So if you can get the work done in
Yeah.
30 days, you can get the money back, right?
Yeah.
Okay.
Yeah, it's a
as soon as you
pretty
get it
easy
done and you-
process to get it back. It's
Does the
you know,
bank take pictures? They got to inspect it. How's that work?
depending on the nature of the repairs, if it's something like termite work, they'll take an invoice from the termite company certifying the work's done, release the funds back to you.
Well, usually the banker goes out, will walk the
if
property
it's
or no?
depending on
lot.
location. I
Yeah.
mean, sometimes they
We'll
will
take
to make
pictures and send 'em.
yeah, we'll take pictures and send them. If the banker's in the area, they'll do it just to. We've got a good relationship with our lenders, so sometimes they'll go out if they're closer than we are. They'll go out, take a look at it, so they can authorize the bank to release funds. So, having the relationships with them helps expedite the process as well.
Okay, so let's do a couple. Let's do a couple rapid fire questions before we get to walking through the process of a loan. You guys can answer. So, Krystle, do I need experience to qualify? And if I don't have the experience as a seasoned apartment owner or somebody, am I going to get hammered on rate and fee? I'm a rate, fee, and LTV.
You don't need experience to qualify, but most lenders will probably require that you get professional property management.
Okay.
Usually for about 12 months,
Okay.
at least until you have experience. in
Mitch,
the
I know you've
field.
answered this, but what is the typical timing we're looking on closing a loan here?
45 to 60 days.
Would that be the same for refinancing?
Yes.
Okay. Krystle, what are the typical costs? What are the costs? Basically you don't have to give me a number, but what's the stuff they're going to be paying for?
So that's not really a rapid fire, but I'll tell you. So you have to pay for your appraisal. Appraisals are more expensive. Some lenders have it where they pay for it, but generally speaking, appraisal is about $2,500 for apartments.
And then up if the building's bigger, right?
Go and up. Yeah,
Okay.
if the building's bigger,
If
but
it's
like
100-unit building, it's not going to be $2,500.
no, it's not gonna be ducks. It'll be bucks, but it'll be it'll be like $2,500 is kind of the starting
Okay.
price
That's
for
it.
an appraiser. So then you have underwriting and processing. A lot of lenders have like kind of standard like 12.5 basis points or something like that
Okay.
for processing. There are a couple lenders that have like a $5,000 flat fee. But you've got your escrow, title, and then points. So it's really pretty standard for an apartment loan to pay a point to your broker. Sometimes, like I said, we get rebate and we'll pass that savings along to our client if the bank's going to pay us partially.
Okay.
But so a point, appraisal is more expensive, underwriting, processing. So, I mean, all in all, your loan could be like as a rule of thumb, almost like 2 points, 1 point to the broker, 1 point for...
Depending on the loan size.
And then,
you
I
know,
mean, if it's a $5 million,
one and a
it's
quarter
not-
to 2%,
Yeah.
just depending on the loan size.
So
obviously.
the other thing is just to address real quick, when it comes to cost, I know when you do commercial, which people aren't used to, if I do residential, it's like, okay, I got to pay for the appraisal up front, which is, let's say $500. But with you guys, I got to sometimes get a deposit of $3,500, $5,000, whatever it is, depending on the deal. It could be bigger, right?
Yeah, so that's the good faith deposit, and that I guess kind of ties into the loan process. So You'll get a letter of interest. It outlines all of the terms, what the loan,
So
what
you
the lender's
submit the
qualifying up front.
So I get an escrow on a property. Right, let's just go through this. I get an escrow on a property.
Yep.
You already have all my paperwork. We've already sized this deal. You got my W-2, with all the stuff you need, right?
We've prepared a financing quote for you too. Once we size it, we're like, okay, we've already had conversations with our lenders at this point. Like, these are the couple of programs or options that you have.
Okay.
We'll go through those. You pick an option. So
Okay.
once you do that, then we
I want the 7-year arm, 7-year fix.
So then we go to our lender. We get what we call a letter of interest, which is basically like, yes, we want to do this loan pending third-party reports or something crazy that we don't know about.
Okay.
Yeah.
So that letter of interest basically outlines those terms. You want to move forward. You sign that. You give what we call a good faith deposit.
Okay.
That deposit will allow us to order the appraisal and start like processing the file.
Is that refundable?
Yeah.
It's credited towards your closing costs.
Credited towards
It's not-
closing cost. If the lender denies the file or something comes up, you
or you
back out
cancel,
of it.
let's say,
Yeah, you cancel before it gets to the full process. Any funds not used will be credited
Okay,
back.
cool.
So, say you give $3,500 and they haven't ordered the appraisal yet, but they've pulled credit and ordered flood and whatever. So you'll get that minus their $75 charge
Okay, cool.
or something like that.
So basically, the letter of interest comes back. You guys submit the file. Letter of interest comes back and says, we want to do this loan. We need X, Y, Z. And then, Mitch, what happens from there?
From there, well, there's a couple things that you can rate lock too. So that you'll have a
This
rate.
is the time where I'd rate lock once the LOI comes, right?
Once the LOI
Okay.
comes back, then
Or
we're
anytime throughout
able
the
to rate
process.
lock or
Which is
anytime
another
through the
cost.
process. So
No, it's a deposit.
so yeah, the rate lock is for standard lenders. It's a 1% of the loan amount, and that's credited towards closing cost.
Okay.
It's a deposit.
It's a deposit. It's a rate lock deposit,
Not a
and
fee, deposit.
Not a fee, but yeah. So for $1 million loan, you're writing a $10,000 check before you have an approval. Sometimes people get a little scared of that, but are you going to be more scared if the rate goes up and you're not locked and now you
So
don't qualify
percentage-wise,
for
how
that
many
much?
people lock in?
I'd say like 70% of the people lock
Some people
in.
just float.
Well, it depends on the market we're in too.
Yeah.
Like, if we think rates are going up, of course, like, we even recommend that you rate lock. But if we think rates are going down, then we kind of play the market a little bit. And some clients want to take a little more risk with that than others. So the deposit, though, we should say is that it's credited back to you at closing if the lender doesn't perform. Like, let's say they said, we're going to give you $1 million loan, but now we can only give you
They'll give it back.
$900. And you say, like, then I can't buy the property because I don't have that money. They'll give you back that rate lock deposit. But
If
if
you
you
cancel-
cancel for whatever reason,
You are
it's a
screwed.
fee. It becomes a fee.
It becomes a fee. It's
Yeah.
they've
Francisco.
allocated those funds from their lending amount for that loan. So
Okay, so I rate lock. I give you my 1%. Now keep me going down the road here.
yeah, so next is we're going to gather any information that we're missing. This is where we'll
Tax
get the tax
returns,
returns, the
bank
bank statements, driver's license, copy of your entity docs. So if you're going to close in an LLC, we'll need the operating agreement, the statement of information.
If you're closing
it's going to
in
be
a
in a
trust,
trust. We
you
need a
need
copy of
trust.
the trust agreement. So this is where we're in the gathering
If they
stage.
need if they're requiring you to get a property management company, we got to go get
contract.
Yeah, we'll get the
okay.
contract, and that doesn't necessarily need to be done like up front. That's something
You're going to need a copy of the insurance, though, right?
Not necessarily
Okay.
up front because there's not insurance in place for a purchase.
cool.
So
Okay.
for purchase, we'll get a quote.
Okay.
But up front, we'll be gathering the documents, preparing the loan application package. So it's going to be the lender's loan application, transposing all the information onto the lender's forms, so it makes it nice and pretty for them to review. You'll sign that package, we'll submit it in, and the underwriting process will start. They'll go through, they'll do processing, they'll review anything that we're missing so we can gather all the documents. And meanwhile, in the background, this 3-week appraisal is going along. So when the appraisal comes back, our job is to make sure that we have everything the lender needs for a full review once that appraisal's back.
So appraisal's back. How long are we talking?
Usually
3
within,
weeks?
within
3
2
weeks.
weeks of
Okay.
closing. Now, once the appraisal's back, you can close within 2 or 3 weeks.
Oh, once the appraisal's back, yeah, then it goes into final underwriting. That's usually
So if the
3 to
appraisal
4
comes
day
back
process.
clean, you look good. Is there any alarms or any things you'd have to be concerned about where you could run into problems
Well, aside from like some sort of repairs at the appraiser notes,
or expenses?
and we kind of. So this is the thing, though. Like, because we've done this for so long, if we see a property up front, we're already, first off, we drive most of our properties before we even go give a letter of interest or a financing quote. So we're like, hey, if this is X, Y, and Z, like, you might want to take care of this, because for us, we know that if you've got problems with your property up front, they're going to start nitpicking. So the last thing you want is an appraiser nitpicking because you could have maybe done something, a couple of small repairs that would have kept them from going like, this is wrong. What else is wrong?
Yeah, like the appraiser's walking in and the gate falls off when he's walking in.
It's just
We're
it's like
generally-
Fix that before he
like
goes.
residential.
It's first
They see a
impression
hole in the wall.
matters.
They're gonna say, "What's else?"
Yeah,
is there?"
first
generally
impressions
gonna-
matter
yeah,
on appraisal.
And we like
And
advise you on this stuff. I mean,
there is a video or something on appraisals we have in the YouTube channel.
I think.
Hashtag
Hell, I don't know.
promotion YouTube
But
channel. Check it
Yes.
out.
There's
Pacific
plenty of
Shore,
stuff.
YouTube.
Not,
If
I'll
not,
make
we will
one.
put it
Check
in
us
there.
out.
If
If
I'll
not,
make
Mitch
one.
will send one to you. When you work with this fabulous
that's
team,
a
Mitch
blog
will
post.
send one to you. No,
Yeah.
that's one of the emails that go out.
Oh, there you go.
See?
But yeah, so anyway, when you're in the process, it does. So that's one of the things that will guide you for that. I think I think the biggest concern that I see for somebody is, again, this is not a residential loan. So if the appraiser comes back with higher expenses, because that happens sometimes, they may have to adjust the loan amount. So this is the thing for buyers. You're used to being like, I need my loan approval in order to remove loan contingencies.
Doesn't work like that.
Well, yeah, you're not going to get your approval, which is for us a commitment letter, until after the appraisal's back, after it's gone through final underwriting, and then you close like a week later.
But are you typically removing contingencies before that?
Sometimes.
Depends on what's written in your contract.
So experienced.
I will tell you that in a competitive market, absolutely.
Okay,
like
so-
for us, if you're
We
experienced,
do it.
we'll say I'll
We'll
drop
do
it
it.
because I feel good. Like
So,
I know that I know.
So
alone.
if you're new to buying apartments, please listen to what we just said, because this is important. This is not residential. This is like the big boy leagues, if that's what you want to say. Is if you're in a competitive market and you want to get deals, and you're going to go back and say, I'm not going to remove contingencies until I get to commitment, you probably will never get any good deals. I'm just telling you right now. Like, we literally will remove contingencies, sometimes inspections, stuff like that, in 7 days. Why do we do that? Because we have experience and we know what we're doing.
and also it gives us a competitive advantage over
But
other offers.
this is comes back to when we finalize the deals. This is why we're talking is so important, that who you work with. That's why brokers that have been doing this a long time, that not honestly know what they're doing, have done $1 billion in deals, and also own properties and actually bought in properties and been through this many, many times themselves. This experience gives you confidence as a new buyer, right, to make sure you can close this deal. So, Mitch, now that we've got our appraisal back, everything looks good, we're going to close. What's the last week or two look like?
So last week we'll get the commitment letter, review everything, see if there's anything that's needed prior to docs or prior to funding, start knocking those conditions off so we're ready for closing. As soon as that commitment letter's signed, the lender starts drawing the loan docs. Loan docs are usually ready in a couple days. We'll get those signed back. The lender reviews them, and they're ready to fund. So, as soon as your closing funds are into escrow, the lender sends their closing funds to escrow. You close, record, and you're the proud owner of a new apartment building.
And somebody's going to show up with a bunch of keys.
Yeah,
now the real
and
fun
hopefully your property manager's there to take those keys.
And we'll do another show soon on once you get those keys of what to
What do you
expect.
do?
Because guess what? This loan is a piece of cake to what's coming up next. But don't be scared, because once you do one,
You make it sound so daunting.
no, it's not. No, but if it's new, it's new.
Yeah.
If
Trying to
it's,
scare everybody?
no, of course not. A lot of people in apartment. Okay, so last couple questions here. How do I know I'm getting a good deal? Number one. And then the other question is should I be talking to multiple different people or lenders? And I know nobody ever wants to talk about this, but we are going to talk about it. Is like, what if I call you, I feel comfortable? Should I go shop you 10 different times? Am I going to get the best rate deal? How do I know this?
So, I mean, for us, a lot of our business is based on referrals. So they're people that were referred by people we know really well, or they're clients that we've already done a lot of financing for. So sometimes we get shopped, and I encourage it, but a lot of times, people won't shop us because that's our job. I mean, we're brokers, so I don't work, for one bank. I look at the landscape of all of the lenders that are out there and see where they're at. And it's true. Some lenders, like, with multifamily, it's very common that a lender will be like, we have a lot of loans right now. We're going to push up the pricing and just kind of like slow down the pipeline a bit. And then other lenders are like, hey, we need a lot of loans, so we're going to drop our margins. We're going to get a bunch of business in. And they do this. They go back and forth. So it's our job to be constantly in communication with these different lenders and know what they're doing, what new programs are coming out with, who's the most competitive.
And also, who's the most competitive for this property type in this area, because not everybody is.
Well,
Exactly,
and your
for your
goals for the
location.
property too.
Yeah.
So we take into account what your goals are. Are you looking to buy this property and you know that if you raise rents, it's going to be worth more and you can get some cash back out of it? We'll put
Why
you in
would you
something
do a
with
prepay or
yeah,
short
maybe you go with a little bit higher rate for a shorter prepay. So there's a lot of things to consider. So I guess all in all, like, yeah, look around, see what's out there, do a couple Google searches. There's nothing wrong with that, but come talk to us. We'll take care of you.
Is there going to be a difference in a rate and term and all that if I'm doing a purchase or refinance, cash out, whatever? Is there cash out hits like this,
No.
like this stuff?
No, typically there's not. There may be for some smaller amounts, but
If you have a loan amount like under 50%, like residential, could it be a little bit better
could
pricing?
get a
than
little better
70%?
pricing.
yeah. So lower LTVs, there's
There
some
could
rate
be a little.
concessions. Higher loan amounts, there's some rate concessions. But they're not really different for purchase or refinance or
So,
cash out.
question for both of you. So hopefully you don't.
But
give me
that
the
is
same
something
answer.
important to note is that some lenders have a minimum loan amount. So some might be a minimum 500, minimum 750, minimum $1 million. One of our lenders is minimum $2 million right now. So again, you kind of need to know which lenders are allowing smaller deals, bigger deals, and things like that.
So both of you guys answer this. Hopefully you have different answers to the question. Krystle, what are the 3 most important things to a consumer, anybody, when they're getting multifamily financing? Give me your 3. I don't care if there's 5. I want 3. What to you?
Okay, 3 for me would be the prepay.
Okay.
I think that's super important because if you're looking to grow like we're trying to grow, you want to know what your prepay might be in case you sell or refi or do whatever you're going to do. The interest only. We didn't talk about that. I'm always looking for interest only. I think
To maximize cash flow.
Yeah, I want to maximize the cash flow. So that's another thing. And then I guess your interest rate is important. 3rd.
Okay.
I mean, for me, I'm going to look for, I've got to have the prepay, the combination of the prepay and the interest only. And then the next thing I want is the most competitive rate.
Mitch, can you give me 3 other ones outside of that could be important?
No, that's the 3 I was gonna say. Well, I guess the cost, your total cost in.
I think that's important.
Some lenders are gonna be a little bit pricier, so that's one thing to consider.
Come on, screw 2 more together.
The qualifying rate and the debt coverage.
coverage,
So
okay. Those are
Affect your loan amount.
Yeah.
that'll affect your loan amount. So
That covers-
those also, if you're going in, you want to put the minimal down. That's another thing to kind of consider. If you've got a higher qualifying rate or a higher debt coverage, you're going to get less loan dollars. So that's another thing to look out for.
So my understanding, to wrap all this up, is when you're shopping for an apartment loan, a multifamily loan, the most important things is when you go to a lender, they should understand what are your goals in the property, what are you looking to do short-term, long-term, and based on those, and if you're experienced, you already know, you've been down this game, but if you're new, based on somebody asking you those questions and understanding you, that should really back into what type of loan you do, what type of prepay you have, what type of interest rate you have, and things like that, because you might decide to do, I don't want to prepay because I'm going to turn around and sell this in 2 years, or cash out in a year because I'm putting all this money in, and I might have to go somewhere with interest rates a little bit higher, but I'm not going to pay a 2%, 5% prepay. So basically what I'm understanding is whoever you're going to work with, whoever you're going to go to, if hopefully they have experience, they understand the process, and they're not just throwing you into some loan just to make a quick buck, because this could really, because it's true, and not understand you, because this could really screw you in the short term if you go to sell or whatever.
And I don't think it's like somebody doesn't understand. I think for us, like, we're not transactional, we're relationship oriented. So for me, like, I want nothing more than every person in the world that I come in contact with to own apartments. Like, I just think it's the right way to go. I think it's the best way to build wealth. I think it's really like your retirement plan. Like I think that's the best
And the
retirement
tax
plan.
benefits.
So
huge.
for me, and Mitch, we're always looking at your portfolio as a whole or your goals as a whole. Like, how can we help you to move along in the process? Or what if you're not getting to the loan amount you need? How can we help you to strategize to get where you need to be? You know, we're looking at the whole picture, and this is a relationship rather than a transaction, which is a lot different than what a bank is looking at. Banks are transactional. Like, you don't go to the bank anymore and have your like relationship banker Joe or Bob that you say hi to like every day, and they're gonna like give you a good deal because you have this relationship with the manager. No, the banks have a box. You either fit in it or you don't. They want you to do all your paperwork. They want you to do, like, they're basically just passing things along.
Yeah, they've got a limited product
strategic.
availability.
So you need to grow your portfolio. You need to be strategic. So you need somebody who can help see your vision and help you to execute on it.
Cool. So my takeaway, the last thing, thanks guys. Check them out, Pacific Shore Capital, Krystle and Mitch. But one of the things that reminded me today that's really important is when you use a mortgage broker, one of the huge advantages is because the bank you could go to, they could be inundated with loans. They could have changed guidelines. They could have pushed up their DCR. They could have raised interest rates because they're busy. There could have been all these things, and you didn't know that the bank next door that you didn't even bother checking with didn't do any of those. They have a better rate, better term, better prepay, and could have put you in a better spot. And so that's one of the things. This is why I believe, and I know you guys do, not just we're mortgage brokers, but when we even go look for our own loans, even though we know every banker in town, we're not going to go, hey, Bob, we're going to go to you because we're best friends. No, we're going to Bob because he has the best deal. So we would go, I'm going to go to you guys because you're going to go to all the Bobs out there and you're going to find me the best deal. And that's
we do this all day, every day. So we know what the lenders are offering. We're in tune with the market, and our relationships. They'll let us know if something's changing or something's coming up, so we're able to place people in the best place.
We're working on other deals with them, so we know. It's like we know what people are offering.
So thanks everybody for tuning in, and we will continue this series talking about commercial loans, and then we'll also dive into, obviously, like you said, once we close and stuff like that. So hopefully this brings value to you. Thank you. Thanks, guys.
Thank you.
Thanks.